welcome to the OTCQX Best 50 Virtual Investor Conference. On behalf of OTC Markets, we are pleased you have joined us today. Today's presenters represent some of the top performing companies on the OTCQX Best Market in 2025 based on share performance and volume. Our next presentation is from J Sainsbury. If you wish to ask a question, please submit it via the Q&A box on your screen. Today, I'm excited to welcome Amy Morgan and James Collins of the Investor Relations team at J Sainsbury, which trades on the LSE under the symbol SBRY and on the OTCQX under the symbols JSAIY and JSNSF. Welcome, Amy and James.
Great. Thank you, Michael, and thank you everyone for joining us today. I'm going to start with a brief introduction to Sainsbury's, and then I'll hand over to James, who will share an update on our investment case, strategy, and key commitments. So Sainsbury's is the second largest grocer in the UK and is one of two listed food retailers, ourselves and Tesco. When we look across the depth and breadth of our assets and the combination of our brands across our physical store estate, product assortment, supplier and customer relationships, winning culture, and robust financial position, what really distinguishes this business above all else is our brand and our heritage in food. For over 150 years, we've been at the heart of Britain's relationship with food, and we have built a strong reputation for providing great value, outstanding quality and range, and leading customer service. We have around 600 supermarkets, generally in edge-of-town locations, and more than 850 convenience stores across the country, although we have a particularly strong London and South East presence. Over the last year, more than 70% of the UK population have shopped with us, with more and more customers choosing us as the place they come to for their big trolley weekly shop. We are growing volumes faster than the market and are consistently taking share. Alongside our food business, we are setting the standard in retail media through our Nectar 360 business, which is powered by our Nectar loyalty platform and coalition of partner brands. And we are one of the largest general merchandise and clothing retailers in the UK, particularly through Argos, which is one of the UK's leading digital retailers with a strong presence in electronics and household goods. Just briefly here, you can see a breakdown of our sales, with around 20% of our group revenue coming from non-food and 13% coming from the sale of fuel. But clearly the vast majority of our income is from our grocery business. We'll be reporting our 25-26 results at the end of April, but in the previous financial year, 24-25, we delivered just over £1 billion of operating profit, which represented more than 7% growth year on year. This was driven by double-digit growth in Sainsbury's operating profit, which reflected strong grocery volumes, the delivery of operating leverage, continued growth in Nectar 360 profit contribution, and good progress in our cost savings plan. For your reference, the Sainsbury's business makes around a 3% operating margin on average. Operating profits in Argos were lower year on year in 24-25, and we are underway with a transformation plan to support Argos's performance in a general merchandise market which has been subdued and highly competitive. I wanted to give you a little more detail now on each of our brands. So our Sainsbury's business is all about good food, and we're there for customers wherever and whenever they want to shop with us. We have a strong groceries online business with around 14% of our food sales coming from online shopping, which is increasingly supported by on-demand immediacy shopping. We fulfill our online business entirely from our own stores, and we use third-party partners to support with fulfillment of our growing on-demand business. Alongside our food offer in Sainsbury's, we also have our Sainsbury's general merchandise business, our two clothing range, and Smart Charge, our ultra-rapid electric vehicle charging network. Our Nectar loyalty scheme is well loved by customers, with more than 85% sales participation. Customers can earn and redeem points in our stores and with our coalition partners, and since 2023, being a Nectar user gives customers access to lower prices on around 10,000 products through our Nectar Prices offer. We were also the first to market with personalised prices in 2021, And this year we rolled out our personalised Your Nectar prices across all our stores and online, so customers can access up to 10 personalised offers each week, comprising their favourite products and new recommendations based on their shopping habits. We're confident there's further we can go in this space and are continuously advancing our offer and driving digital engagement through our Nectar app. Nectar 360 is our loyalty, insight and retail media business, with more than 900 clients and media agencies now partnering with us to run retail media campaigns. This year we launched Nectar 360 Pollen, the most advanced retail media platform of its kind in the UK, which will enable clients to book, plan and activate their retail media investments and utilise our market-leading measurement capabilities for their campaigns. And Argos, as I said previously, is one of the UK's leading general merchandise retailers. What really sets Argos apart is its convenience. Customers can shop with us through our website, our Argos app, standalone Argos stores, and conveniently located Argos stores inside Sainsbury's supermarkets, and can collect their order from one of more than 1,100 collection points in as little as 4 hours post-ordering. Now you can see here that over the past 5 years, we've really been on a journey to rebuild our share of the grocery market. James will cover our strategy on that in just a moment. If we look back to 2014, we had a share of almost 14% of the market by volume. However, from 2014, we really started to be impacted by the rise of the limited choice supermarkets, Aldi and Lidl. And you can see the growth in their share more than doubling over the last 10 years. Their growth has had a significant impact on the industry, with market share pressure for the full choice supermarkets, whose economics were impacted as they tried to compete on price. However, over the last few years, the rate of growth of the discounters has slowed as they've struggled to find new locations and increasingly cannibalised themselves. And at the same time, we have fundamentally reset our strategy, investing to bring our prices to a more competitive level and refocusing our business on food. So now we are back in a position of growing our market share and are consistently outperforming the market on volumes. In Argos, we are best known for our range of consumer electronics, household electricals and gaming. And across our offer, we are focused on extending our ranges to offer customers more inspiring choices. Over recent years, we have been focused on relocating the Argos estate from standalone stores to stores and collection points inside Sainsbury's, ensuring greater ease of collection for customers, whilst at the same time reducing our cost to serve. Almost 80% of Argos sales are now through digital channels, and we are increasingly focused on improving the digital journey, and we're encouraging more customers to shop with us through the Argos app, which is delivering greater shopping frequency. I hope this has been a helpful introduction to our business model and our brands. I will now hand over to James to cover our investment case, strategy and key commitments. Thank you.
Great, thanks very much, Amy, and good afternoon or good morning, depending on where you are. I'm just going to briefly cover first our investment case. So effectively why you should invest in Sainsbury's, the proposition that we promise and that we aim to deliver as a business. So we established our next level strategy in February 2024. So we're around 2 years through a 3-year strategy. And at the heart of the proposition that we're talking about is delivering profit leverage from sales growth. So i.e. fundamentally delivering a level of profit growth that is higher than sales growth. Why do we think we can achieve that? Because we expect to grow our food volumes ahead of the rest of the market. We expect to deliver a level of cost reduction ahead of the rest of the market. And ultimately that gives us more capacity to reinvest the benefits of leverage and of cost savings back in the customer proposition. That ensures we remain competitive, and we should also be able to drop that through at a good level of profit growth. Linked to that and kind of controlled and disciplined capital investment, that should deliver good sustained cash flows and high return on capital. And this is a real focus for our business in an industry which historically has not generated great returns, and where particularly in the time of the UK space race, where there was a lot of new space being put down in the UK, returns were diluted. We're now really focused on making very good returns on the capital that we spend, particularly on real estate, where historically that's been an area of weakness across the whole of the industry. So really strong, reliable cash generation, really key, and then that should in turn deliver enhanced returns to shareholders. So good, strong, sustained cash flows as a business. So we, for the last 5 years, have promised to deliver at least £500 million of cash flow per year. And broadly, we've been returning that to shareholders, number one, in the form of a dividend, where we have a progressive commitment. So that is returning at least £300 million a year to shareholders. And in the last 2 years, we've also been buying back shares. So broadly, that sort of £500 million plus we've been returning to shareholders. We've also done a divestment of a financial services business in the last couple of years, and we've returned that to shareholders, firstly through a special dividend and through enhanced buyback last year, and actually we promised also in the year ahead of us. So that's the key investment case, is really about those good, dependable cash generation feeding to kind of good, consistent cash returns to shareholders. Moving on to the kind of the recent history of the business, this is really important. So we had a management change and a strategy change back in 2020. So actually, just as we went into the pandemic in the UK, and it really we had a very tight focus on really focusing the business back on the core food business. And you can see these are some of the summaries of what the first 3 years of that delivered. So 2020 to 24 is basically describing the first 3 financial years of that strategy. So we went from a position where we were growing volume, or basically our volume growth was below the market, to growing ahead of the market. We did that in part through investing very, very heavily in our price position. So we basically acknowledged that we were not as sharp as we needed to be on pricing, and closing a lot of the pricing gap versus our key competitors. So particularly versus the discounters, we reduced our price versus Aldi by about 16%, versus Lidl by about 12%, and by the other big box retailers by between 2 and 5%. And so basically taking away a price position which was uncompetitive and making us competitive. And at the same time, it wasn't just about price. We recognise that as a brand, people expect great quality from us. They expect innovation. They expect interesting products. So again, we more than doubled the rate of innovation. So new products we're bringing to customers all the time. And at the same time, we've invested in our proposition in terms of customer service. So i.e. availability, customer service, and the quality of the experience that customers expect in stores. Now, I guess it's a fair question, how do we do that? We accelerated our rate of cost saving very considerably. So we generated more than 1.3 billion of cost savings over those first 3 years. And that more than doubled the rate of cost savings that we had delivered in the prior 3 years as a business. So really, those first 3 years were about becoming competitive again, getting ourselves to a price position where the rest of our proposition, where we have a great reputation and delivery on quality, range, availability, etc., really starts to sing through without customers feeling they're spending too much, or we're charging too much for that. If we then move forward to the strategy cycle that we're now in, so we laid out the next level of Sainsbury's strategy in February of 2024, so a little bit more than 2 years ago. What was the kind of key focus here? Well, so our purpose is written there. So we make good food joyful, accessible, and affordable for everyone every day. So that's ultimately the purpose that sits behind us as an organisation. And again, no surprise that the first priority is about food. And what we're talking about here is basically aiming to be the first choice for more customers. So effectively delivering more range to more customers in more locations in the UK. And really importantly behind that is our commitment to creating a sustainable food system in the UK. like a lot of the globe, and particularly across Europe, we are seeing challenges in terms of the resilience of food supply. We are seeing challenges in terms of food supply being delivered in an ethical way and a sustainable way. And as a business, we've had a long history as a kind of 150-year-old family business of delivering on standards better than people typically expect in terms of provenance sourcing. And we've really leaned into that. So we're putting in more and more long-term supply relationships that we think will stand us in really good stead in an environment where the resilience of food supply is becoming more and more challenged. The rest of the priorities here, loyalty, Amy talked about earlier. So we do think that we're world leading in terms of loyalty. And that's important in terms of the customer proposition, but also generating revenues through retail media. More Argos more often is about improving the customer proposition. So Argos has a great range for being super convenient and really fantastic in terms of the speed and convenience of delivery. What we need is people to arrive at Argos more often and choose it more often. So we've been working a lot on range and the digital proposition. And then, again, can't ignore savings. So we're targeting another 1 billion of savings over the 3 years, again, ahead of our competitors in terms of being able to reinvest that back in becoming a more efficient business. So those are the kind of 4 priorities that we laid out. What does that mean in terms of the commitments we gave? So all through, actually, the last few years, we've been very, very clear about a consistent set of commitments that we judge ourselves by as a business and that we report on every time that we stand up and talk about ourselves as a business. So we aim to deliver food volume growth ahead of the market, and we've done that consistently. Customer satisfaction higher at the end of the strategy than it was at the start. Likewise with colleague engagement. So those are some of the inputs, if you like, and then on the outputs, we talked earlier about delivering profit leverage from sales growth. Cost savings, a key part of being able to fund that and remain efficient. And more than 1.6 billion of retail free cash flow over 3 years over the strategy. I mean, at our current level, our market cap is around about 8.5 billion. So that's pretty significant as a proportion of market cap. And again, I talked about returns earlier on, so high return on capital employed, and all of those feeding through to good, consistent cash returns to shareholders. So kind of then winding forward, where are we 2 years into that kind of next 3 years of the cycle? You can see where we are on value perception. You'll see the dip down from 2021. So this was across the whole industry. Actually, relative to the industry, we were performing well over here as we improved our price position. But at that point, there was very significant inflation in the UK, as there was in plenty of other countries. But what you can see really is the huge progress that we've made. So we're now in a much, much stronger position than when we started the strategy. Quality perception has been pretty much on the up over the whole of that period. And availability, so super important with customers, is that they find what they need when they come into store. And again, from an operational point of view, particularly in terms of the AI that we're putting behind our food supply chain systems, we're really delivering great availability whilst also controlling stock holding. So got really important proof points of how we're delivering as a business. And ultimately, this is the real test, is that we're growing what we call primary customers. And these are really, really important to us because these primary customers are defined as customers who do the vast majority of their grocery shopping with us. So, we've never had a problem in terms of our sheer number of customers. We are blessed from a kind of historical point of view. We have a very, very good store network biased towards London, the south and southeast of the UK. So we have plenty of people passing through our stores, but not enough customers were choosing to do their big weekly shop with us, primarily because of the issue that there was on pricing. As we've addressed that and people are more comfortable that we're in the right place on value, more customers are choosing to do their full shop with us. And particularly, we're taking more customers, those full shop customers, back from the discounters. And this is a really, really important aspect of our economics because the more big basket customers you get coming through your store and shopping with you online, that's a real, real driver of profitability on a business with ultimately a high cost base. And you can see what that's done on the right-hand side in terms of market share gains. Importantly, this is volume market share. So So you can see that in the first couple of years, that flatlined. When we're investing first, it takes a long time for people to realise and recognise that you're improving your value. And you can see over the subsequent 2 years, the very significant gains that we made in volume market share. So again, delivering on that commitment to grow volume ahead of the rest of the market. So quickly, just moving on to the final slide and the conclusion, and then obviously happy to take what questions you have. Where do we stand now as a business? So if we, in the kind of space available, we've not really been able to describe the industry that much, but really importantly, I think on the left-hand side of the business is where we are really comfortable that we've got to a very, very strong business that's really consistently delivering. So delivering on value, delivering on quality, and delivering stores which are being upgraded and ultimately matching customers' expectations to get a better range, better fresh food, and better service in our stores. So that, if you like, is the left-hand side of this chart. Those three on kind of the competitive position, putting more space down and the right space in the right locations, and delivering on quality. On the right-hand side are the things where these are things that we're investing in that we think build a competitive moat for us as a business. So we've been outperforming the rest of the industry now for 3, 4, 5 years. What's the thing that provides us with confidence that we think we'll be able to continue to do that? It's the fact that we are not just banking all of that and underinvesting and taking all the cash in as a business, but we're reinvesting back into the business. So we're investing, as Amy said earlier, in personalisation through our loyalty scheme, investing in the digitisation of our stores, making them more efficient and more attractive to customers. We're investing in efficiency through significant investment in technology, in automation, in AI, where in an industry that moves very large numbers of quite low value items, huge millions of items per day, automation, technology, AI can make a real difference in terms of making us more efficient. And again, likewise, those can deliver structural cost reduction. So big challenge for us, as would be the case across many industries, is the cost of labour, and is far and away our biggest operating cost. Through investment in technology, through investment in infrastructure and automation, we're taking manual task out of our stores, out of our delivery depots, and that's making us a much more efficient business as we go. And importantly, these aspects on the right-hand side, which require capital investment, this is where we are reinvesting. There's probably only one or two other people in the industry who are investing at this rate, and we're building this competitive moat versus competitors, particularly so kind of significant number of highly leveraged competitors in the industry who are not doing this. And that means that we can deliver more efficiently over time. So that is the presentation concluded. So I'm happy now to pick up a few questions.
Great, and thank you to everyone who has submitted some questions to us so far. I'm going to start, James, with a question about cost savings. So within our cost savings plan, how much are the cost savings coming from structural changes, so for example, automation, versus taking out discretionary costs like marketing?
Yeah, it's a good question. So we often talk about our cost savings being structural cost reduction because, frankly, particularly in this industry, and I've been around in this industry for pushing more than 30 years now, anyone can cut cost, and actually anyone can cut costs in the short term with relatively few consequences. Again, in the short term. But ultimately, over time, customers will notice. You will become less efficient. If you don't invest in your technology, you'll start to have challenges in your systems. So our programs, where we are now very, very well developed in terms of the way that we identify and deliver costs, are very much aimed at structural, permanent cost reduction. And again, we've had to be a lot more honest with ourselves as an organisation. Historically, we claimed lots of cost savings, but also let a lot of cost into the business. We're really focused now on reducing our SG&A to sales. And at a time when labour costs are rising way ahead of food inflation all the time, that is quite a challenge. But that's the objective that we set ourselves as a business.
Thank you, James. Next is a question about Nectar. So what is the contribution of Nectar to group income, and how does Nectar support the Sainsbury's and Argos businesses?
Yeah, so number one, in terms of the contribution, we don't specify an actual operating profit contribution at the business. It is pretty substantial, and the reason that we don't specify it separately is that we think it's not the right way of thinking about it as a business, because frankly that income stream is interdependent with the core grocery business. So we don't think that people should value it separately as something that's growing faster. Yes, it is growing faster, but ultimately, it feeds off and is also contributing to the core grocery business. What we have said is that over the 3 years of this strategy cycle, that we expect Nectar and primarily retail media to deliver at least an incremental £100 million of operating profit. So on a base of a bit more than £1 billion, so that's a 10% increment on operating profit over those 3 years. In terms of what it contributes for customers, also what we're really delivering is very meaningful value for customers. I think a lot of the time loyalty schemes deliver points, and we deliver points to customers, and over time they're rewarded with loyalty, with points which ultimately they can cash in against the future value of their shopping or against other options in terms of spending in hotels, holidays, airlines, etc. So there's real delivery there. However, where we are really building loyalty is in the area of personalised value. So ultimately, customers can be confident when they go into store that they will get access to a range of offers which are only available to loyalty scheme holders. But more than that, every week we're delivering a unique, personalised range of offers through the digital app to our customers, which are typically on items that customers buy most frequently, and it's delivered in a way that we know through the algorithms. We've been running this for 3.5 years, that customers respond really well. So again, thinking about how you deliver value to customers most meaningfully and effectively, it's a very, very good way of getting a really, really good return on investment through your marketing spend.
Great, thank you, James. A couple of questions on Argos. So firstly, what are the operating margins for Argos, and how do they compare with industry averages? And also, how can we distinguish Argos and grow market share versus Amazon and eBay in the UK?
So in the first answer, we don't actually disclose Argos operating profits separately. However, we've given some pretty clear indications in the last couple of years, and Argos profitability is very, very low at the moment. So versus an average retail operating profit of 3%, so the Argos operating profit margin would be below 1% at the moment. So it's very low indeed. And I think the question was how that compared to industry averages. Really difficult to identify an industry average across ultimately online general merchandise retail, but it is a low margin, and ultimately we have the objective of increasing that margin back towards the retail average of a bit more than 3%. Sorry, and the second part of your question?
So just asking around how we distinguish Argos and grow market share versus Amazon and eBay in the UK.
Yeah, so number one, we don't have the same range as Amazon. So Amazon literally stocks millions of items, particularly through Marketplace. We have a much more curated range. But what we deliver, is convenience through that curated range. It's a significantly easier and faster to shop Argos than it is to shop Amazon, and that's the feedback. We know that from customer responses, and also there is the convenience and speed of Argos is something that's unmatched in the UK. So customers can typically expect to order an item and pick it up within 4 hours at more than 1,100 collection points in the UK. So those collection points are often in Sainsbury's supermarkets or in Sainsbury's convenience stores. So they are in very convenient locations with long trading hours, or very close to where people live and work. So there's a huge convenience in that click and collect network, which obviously is for free, and then for a very competitive delivery charge as well. Quite often we're able to deliver within 4 hours as well. So ultimately, Argos is a real go-to for for customers who want the ease, speed and convenience and reliability of being able to choose between rapid delivery and rapid click and collect.
Brilliant. Thank you, James. And just very quickly as our final question, in terms of shareholder expectations for dividends in 2026, can you just set out what our payout ratio is, please?
Yeah, so number one, we have back in February 2024, where we laid out our strategy and we laid out our the kind of commitments and our investment case. We made a commitment to a progressive dividend. So last year, so we haven't announced the dividend for March 26, kind of full year yet, but in the year to March 2025, our payout ratio was a little under 60%. And in the year ahead, obviously, if we deliver on our commitment to a progressive dividend, then you would expect, a relatively similar level of payout and a higher dividend. So I think that's a core part of the proposition. Plus, also, within our capital allocation commitment, we've made it super clear that we expect to be able to finance the business and still deliver more than £500 million of free cash flow. So on top of that, if we continue to generate that kind of cash flow, you should expect a share buyback of more than £200 million. And additionally, we have said that in the year ahead, that we'll return an extra £100 million of buyback, which is part of the proceeds from the bank disposal process last year. So last year, we delivered more than £800 million of cash to shareholders on a market cap of just over £8 billion. In the year ahead, assuming that we deliver a similar level of buyback as last year and deliver on the progressive dividend, then you would expect more than £600 million of cash return to shareholders in the year ahead.
Brilliant. Thank you, James, and thank you everyone for joining and for your questions. If you would like to arrange to meet with us, or if you have any further questions, our contact details are on the slide that you can see currently.
Thank you very much for your time. Thanks.